We've had many apocalyptic warnings about a global house price collapse, and that's driven by very high inflation, soaring interest rates, but also expectations of a global economic slowdown. So in this video, we look at the actual evidence across 4 different countries, the UK, the US, Australia, and Canada, to see what's going on right now. Now, don't forget, if you do enjoy our content, please do subscribe to our channel and like this video. That helps us a lot. So let's look at the global house price situation in a bit more detail. Now, looking at the global picture right now, one of the patterns that we see almost everywhere is disinflation. In other words, inflation, the rate of inflation, is slowing down. Prices are still increasing on a year-on-year basis, but they're increasing more slowly. And that means that the central banks are closer to achieving their goal of getting inflation back down to their targets. At least this is the first step to getting there. So what we're also seeing is a general slowdown in the rate at which central banks are raising their interest rates. We're getting closer to the end point when it comes to their terminal rate, as it's called, for this cycle. And as a result of that, we're also seeing that demand for goods and services is gradually falling, and that includes housing. We're also seeing unemployment increasing, and that's also part of the goal here, because if wage growth is very high, that tends to stoke further inflation. So unemployment is a nasty side effect of higher interest rates. Now, higher unemployment also has a cooling effect on the housing market, because if you're worried about losing your job, you're less likely to take on a huge mortgage. And what we're also seeing is finally house prices falling on a year-on-year basis. The last time I made this video in November of 2022, that wasn't the case, but now generally it is. Now let's turn to the story with individual countries, beginning with the UK. Here are the latest forecasts, the economic forecast from the Bank of England, and this is from their monetary policy report in February of 2023. The numbers in parentheses are their forecast from November, which is their last monetary policy report. And you can see that gradually the situation has improved in the Bank of England's eyes. That's because GDP growth isn't as negative as they expected. So we're going to get a shallower recession, but still a recession, and that'll last some time. And by the beginning of 2025, they're now expecting us to very gradually come out of that recession. But the good news is that by the beginning of 2024, Q1, they expect inflation to come down to 3%. Currently, it's above 10. And furthermore, by the beginning of 2025, they expect to be below their 2% target. They're expecting 1% for CPI inflation. The bad news is they expect that unemployment will be much higher, so 4.4% at the beginning of 2024, 5% at the beginning of 2025. And as we've said, that's going to be bad for the housing market. But if they do manage to get inflation down to 3% by the beginning of 2024, they can also start lowering their bank rate. And they think it's going to be at 4.3 at that point, and then 3.6 in the beginning of 2025. What they also show is market expectations of their policy rate, also for the US and for the Euro area. So the actual bank policy rates are shown here on the left-hand side, and then the extrapolations, the solid ones, are the most recent extrapolations from the overnight interest swap market. Notice that the market expectations are that we're now close to how high these policy rates are going to go. There isn't a lot more tightening to come. And then gradually there's going to be easing by the end of 2023. That's what markets now expect. Now, if we look at the actual fixed rates for the average UK mortgage, and this is for a 2-year fix, but also varying the amount you borrow from 60% of the value of the house up to 95%, those rates have also started to come down. But the key thing to understand is that those won't fall to the levels they were at in 2020, say. We're going to have to live with this new world with higher interest rates. What's the impact been on house prices? Well, clearly negative. So here's data from Zoopla, and this was published in January of this year. And what this shows is the December rate of annual growth. That's in black. And you can see that those rates were generally above 6%, sometimes as high as 12%. Then the purple bars are for December 2022. Those were a bit slower, but still increasing rapidly on a year-on-year basis. But if we look at the annualized rate of house price growth for Q4 of 2022, essentially house price growth has stopped all gone into reverse, particularly for Northern Ireland, London, and generally regions in the south. And for the UK as a whole, on average, we're getting year-on-year falls. The nationwide index also shows a similar pattern. Here we're not seeing year-on-year falls yet. This is as of January 2023. We've still got a 1.1% year-on-year growth, but you can see that if we look at the 3-month versus 3-month change, so that's the latest 3 months versus the previous 3 months, there we are seeing fairly substantial falls. You can also see that if you look at the average UK house price, we've definitely gone into reverse. However, if we look at affordability, you can see that house price to earnings ratios are still close to all-time records. So we've probably got some way to go before housing becomes more affordable, now that interest rates are much higher and many houses are out of reach for many people given how much they can borrow. So is this an apocalypse? No. Is it a slowing? Yes. How far will it go? Well, it depends on what happens to inflation, and that in turn will affect interest rates, particularly if the Bank of England has to hike rates further. My personal view is that right now it looks as if we're going to have a period of year-on-year falls, but it doesn't look like it's going to be a huge market rout. There's still a huge demand-supply imbalance in the UK, which will probably keep house prices fairly elevated. Affordability is going to be a problem, and that's certainly going to weigh on house prices until we get some normalization relative to where it's been in the past. Wouldn't it be great to have a forecast of what's going to happen to house prices? Well, we've provided that for our PensionCraft members. We have a whole suite of these trackers now, and the one we're interested in for house prices is our fair value set of trackers. So we're not interested in gold or silver, we're interested in UK house prices. How does this work? Well, it just multiplies two numbers together. The first one is the average UK income, and we extrapolate that into the future with a worst case, a best case, and a central case, and we do the same thing for affordability. So here we're looking at house price to income ratios. Again, with a best case, a worst case, and a central case. Multiplying together those two central cases, which is accelerating nominal wage growth combined with a normalizing price to income ratio, we get a central case of 2.5% annual year-on-year growth for house prices. And that's for the next 3 years. The pessimistic case, which I think is more likely, is minus 6% per year. And that's a combination of weak UK income growth and a normalization of the price to income ratio to what's more common historically. If we look at the US, it's a similar situation. Here the central case is 1.1% house price growth and the pessimistic case is minus 8%. And again, that's going to combine weak income growth, which we'd expect given monetary policy, and also a normalization of price to income ratios. So certainly not an apocalypse, but not great growth either is what I'd expect. So if you do want access to those trackers, but also all the other goodies that come with membership, such as access to Slack to ask a question whenever you want, but also our huge library of explainers, there should be a link beside me and in the description beneath me. Now let's turn to the US. At the latest monetary policy meeting, Jerome Powell said, "We're seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing." And if we look at the annual change in the average price of a US home, this is the Case-Shiller index, as of November, because it does come with a delay, you can see that there was a huge slowdown in the rate of growth. It was still positive, just under 8%, but there's a clear negative effect of higher interest rates. That index can be broken down into cities in the United States, and you can see that many of them peaked around summertime and they've been falling since, with the biggest falls happening in the cities which had the biggest rises. If we look at the drawdown in house prices, that's the fall relative to their peak and also the timing of that peak, which you can see in these brackets here. Notice that the peak time was often around summer of 2022. Portland was a little bit early in May, so was Denver, so was San Francisco. But generally, the places which had the greatest surges, you can see, such as San Francisco and Phoenix, are the ones which have had the biggest peak to trough falls so far, with San Francisco being the largest at just under 12% peak to trough. Now we can get slightly more timely data from Redfin, And you can see the February the 9th data beside me here. These are the average house prices over the course of 2020, 2021, and 2022. And whereas 2021 was significantly higher than 2020, and 22 was higher than 21, notice that in 2023, prices are roughly where they were a year ago. So the median sales price is only up by 1% relative to last year. So clearly a deceleration here. One measure of how frothy a market is, a housing market, is to look at the percentage of listings which had a price drop. Now that rate has been very low during the course of the last 2 years. It did surge in 2022 towards the end of the year. It surged above 7% at some points. Then at the beginning of this year, we've also seen it rising up to 5.4%. So clearly sellers are not meeting their expectations when it comes to the price that they set their house at. So again, in the US, like the UK, all we're seeing at the moment is the froth being taken off markets. If we compare prices with where they were before the pandemania, then they're still higher than they were significantly. But the rate of growth is about to turn negative, would be my guess. Now let's look at Australia. And here too, we're seeing inflation surge upwards. Here we're not seeing disinflation. We're still seeing the rate of inflation increase. However, my expectation would be that here too, we'll start to see that slow down and turn around over the next few months. But the Reserve Bank of Australia, in its monetary policy report in February, produced this beautiful graphic, which is worthwhile thinking about. What this shows is for each central bank around the world in developed markets, where they started out with their policy rates at the beginning of this cycle. Almost all of them were close to zero, and that was to combat the effects of the pandemic. The red arrows show you how much they've raised their interest rates since the beginning of the cycle. And then the blue squares represent where the swaps market expects they'll stop raising interest rates. So this is the terminal rate. Now the Bank of Japan is just not playing. It hasn't raised interest rates. It's still at zero and it's likely to stay there for some time. But the European Central Bank, you can see, has aggressively raised rates. It's still got some way to go, but it has come a long way in terms of restricting policy. So has Sweden's Riksbank. So is the Reserve Bank of Australia. The Bank of England is almost at its terminal rate, and the Bank of Canada is already there. The Federal Reserve also very close to its endpoint, and the Reserve Bank of New Zealand still has some way to go. But you can see what I mean when I say that the broad picture across all of these developed markets is quite similar, except for Japan, of course. What's the effect been on Australian house prices? Well, no surprises. If we look at the 3-month rolling change in the house prices, we're seeing it turn negative. These are the state capitals, and only Perth is not falling by a significant amount. Brisbane is now falling by 5% on this 3-month rolling estimate. If we look at the 12-month change, the Australian market as a whole is now down 7% year on year, with no signs of slowing over the 3-month window or over the 1-month window. So falling and not slowing down is the pattern we see in Australia right now. But remember, there have been huge surges since the pandemic, as we'll see in a moment. So here are those peak to trough falls, but also the rises after the pandemic. So if we focus on this first column, it shows you the euphoric growth of the Australian housing market, with prices in Sydney rising by almost 30%, Melbourne by almost 20%, Brisbane by over 40%, and Adelaide also by over 40%. The decline from the recent peak is pretty small by comparison, with a 14% fall in Sydney, 9% in Melbourne, 11% in Brisbane, which would be very painful if you bought at the peak of the market. But for those who bought before the euphoria, they're still sitting on pretty big gains. But here, as in the US, you can see that the peaks happen in 2022, with Sydney peaking quite early, but most of them peaking around the middle of last year. So again, still no signs of a huge bloodbath, but the markets which have gained the most are generally the ones which are selling off the most, because their affordability will be the lowest. Finally, let's look at Canada. Starting again with inflation, clearly there are signs of disinflation in Canada. The 1-year rate of change of prices is slowing down, still very high, but going in the right direction. We've moved from a situation where energy prices, those are shown in blue, were pushing up CPI inflation, to a situation in which services, that's the yellow bars, are now a big driver of inflation. Now that's likely to be more sticky because it's based on wage growth. But if unemployment increases due to higher interest rates, then we would expect to see that moderate as well, but it'll probably take a while. So the Bank of Canada expects that by the end of 2023, we're going to see inflation come down to around 4%. So still well above its target, but still moving in the right direction. How's that affecting house prices? Well, it's certainly slowing them down. You can see the average price has certainly fallen from its peak from the beginning of 2022. If we look at some measures of frothiness of the housing market, one of those might be the number of actual sales compared to new listings. That's shown in red. Clearly that got to very frothy levels during 2021 and then slowed down at the beginning of 2022. A kind of opposite measure, which is the months of inventory, which are relative to sales, of course, that fell to very low levels during the frothy period as the amount of inventory was tiny because houses sold so quickly. That's now also normalizing. So that's coming up from 2 months of inventory up to about 4 months, which is much more similar to the long-term average. And then if we look at the actual city by city year-on-year house price changes, almost all of them are now negative. The only exception is here, and that's Calgary, which is still positive on a year-on-year basis. But you can see that that also is a rate which is falling. In conclusion then, we're seeing a similar pattern of macroeconomics, but also house prices all across the world. And that's because of the inflation surge, which was common to all of those countries. We're seeing a tight labour market and worries that energy inflation, which is now subsiding, is going to turn to services inflation, which is driven by wage increases. When I last made a video 3 months ago, we weren't seeing year-on-year price falls, but now we are seeing those. So it's simply a question of how deep those are going to go and how long they're going to last. But assuming that wage growth doesn't fall too much, then I'd expect that the falls won't be catastrophic. For many of these countries, there's a supply-demand imbalance, which will tend to be a support for house prices. Another source of support is that interest rates will probably slow down their increases. And that's because many of the central banks are now close to their terminal rate. Inflation is starting to subside, so some of them will start backing off because what they don't want to do is to crush any kind of growth by having interest rates too high. So yes, the falls are ongoing, and the key things to watch are inflation, particularly services inflation, which is quite sticky, but also the effect of rising unemployment on wage growth. If wage growth subsides, then that could take away some of the support for house prices. So that's a key indicator to watch. So no apocalypse, certainly, but we are seeing year-on-year average prices start to fall now. Now, how long that period of weakness lasts depends on what happens to wages, in my opinion, because that's driving CPI inflation now, and that's also going to affect policy and interest rates, which in turn affects the housing market. So wages are the key thing to watch here. Now, don't forget, if you do want access to those trackers, and also membership of our community, you can find out more about that by clicking on the link beside me and in the description beneath me. And as always, thank you for listening.